I guarantee you'd be a millionaire by the end of even this year. So keep that up anyways. So just don't skip any steps. Just do it in order. Easy. So in this case, you see a top at the psych level. Again, Arctic turtle, right? We're in the resistance zone. But then it stretches out to get the psych level and then collapses. Well, what happens to the turtle that sticks its neck up? Gets chopped off, right? Then the lower low. What do? Lower low? Easy peasy lemon squeezy. And down you move. Now, the funny thing is, if you want to do it like that, funny like a clown, this is our plan 10 days ago. Okay. You following me? No? Okay. Anyone here? Oh, so you do have it? All right, cool. Yes, guys, there is a hurricane going on. So like to Peter, who's deciding like maybe it's the webinar platform. It might be, but it could be the hurricane, bro. So relax and be patient with me. I know you're being patient with me. I know you're patient with me a lot, but most people might take the day off during a hurricane, but I'm here for you. Okay. Cool. Yeah, but I figured you lost. Okay. So cool. So anyways, up into here, which is our trade plan from 10 days ago, hits our target, right, which is this, a monthly pivot, stretches out to get to the psych level, the turtle gets its neck chopped off, thing drops like a ton of bricks, look left, grab this, right, the old support becomes resistance, and you got yourself a simple 1, 2, 3. And the first target would obviously be back to this pivot that started the whole move. But if this is truly bearish, the target is actually 1321. Okay? Not sure why that's there. Okay? 1321. So that's the first stop. That's the second stop. But another way of saying it, though, if you're a bull, you look to buy it there again. Or if you're a bull, you look to buy it way down there. No, I was in Cambridge 2 weeks ago. And then I'm in Cambridge 2 weeks from now. And then I'm in Cambridge again 5 weeks from now. And then I'm setting that thing up. Harvard invited me to show me how Washington, D.C. works behind the scenes through all the media outlets, the think tanks, Congress, the Senate, powerful NGOs, all this kind of stuff. So I'm going to get the behind-the-scenes tour, 2-week tour of Washington, D.C. to meet all the power players. And so I'm going to sign up for that. It's ridiculously expensive, but I think it'd be a kick butt 2 weeks. I mean, I was in Washington, D.C. A year ago. And it was great, but it was like any other tourist, right? Just go to the museum, stand on the Capitol building, go see Abe Lincoln, right? All that kind of stuff, just like any other tourist. This is this is Harvard's introduction to getting crap done in Washington, D.C. And that's the interesting thing about Harvard, where, they truly teach you how to like rule the world, right? I kid you not, in an economics class taught by someone that works at the New York Fed, we spent 2 hours learning what normal people are like. And I couldn't believe it. I actually went up to the professor the next day. I'm like, that was actually quite funny. And she's like, what do you mean? I'm like, look, we're all at Harvard in this beautiful historic building, which dated back to the 1700s. And obviously it was ultra modern inside. I'm like, but you know, I'll never forget the fact that I went to Harvard to learn like what normal people are like. And it was great. I'm not kidding. A whole documentary, a 2-hour video on what a regular person is like. And I couldn't believe it. It was really funny. So you can get an introduction like what it's like to be a single mother with low education working just above the poverty line. You know, it was great. So anyway, so this would be sort of like the rich and powerful's view of how to get crap done in Washington, D.C. So anyways, I'm looking forward to that. Not in the middle of winter, though. All right, so that's ZAR. There's our technical analysis. There's my thought on that. So a bit of improvement for South Africa, or maybe some dollar weakness, which is really good because that's positive for global macroeconomics. Yeah, Joe's like, Harvard's running a diplomatic mill. Yeah, not a diploma mill, but diplomatic mill. Like, think of what are your chances of getting a powerful job in Washington, D.C. if you have a master's degree from Harvard and you worked at Goldman Sachs? I mean, you don't even have to be elected. They just give you the keys. What do you want to do? I want to be Minister of Forestry. All right, boom, there's your job, there's your office. You don't have to do anything now. Show up to the meetings. So anyways, I think there's a lot of humor in it, but there's a lot of reality too. All right, so Beast. Okay. Yeah, right, Joe? They're glad to the common man. I mean, I couldn't believe it. It was so funny. Bum, 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 bum. All right, so just looking at this, Beast is hanging high, huh? Boy, on this time frame, it's a tough one to grab. We're clearly at, you know, at a pressure point, if you want to call it that. But like, how do you buy this if you want to buy it? That is trickier. To me, it looks easier to sell, but it's not moving anywhere on this 4-hour, huh? It's not going anywhere. The only thing you can think of is you kind of have a little wedgie going on. But a lot of people make a big deal of that. I don't make a big deal of that. I think the biggest thing I would do here, or most important thing to do here, especially if you thought it was sloping, is I would just let it break out. I wouldn't try to grab it. I would just let it happen. And then grab the pullback. Another way of looking at this is, you know, we're back above the M2, but the S1 was the one involved, right? That got this going. So I think what's likely to happen based on technical analysis is we're going to head up somewhere around there. You can see that's very close to 150. So you have to decide, I mean, you could buy it now with anticipation, like as you approach this area, you jam your stop at break even, right? I mean, the first resistance is there, second resistance is there. Another way to highlight it if you're a bull is to think, well, where would bears sell? Well, a bear would sell here. I think you'd agree with that. And a bear would sell here. I mean, that's why I drew it, right? So do you buy now and jam your stop before you test these levels? Or do you wait to break this level? But the thing is, you know, to test the 150 area and then have it drop and then you buy it, this is a tough one, guys. Now, I think it's easier to sell this, but it's dangerous because it's not necessarily bearish either, right? Remember, where we want to make our money, like the stuff that's going to pay your mortgage and put your kids through college and buy braces for your daughter, is this kind of stuff where you're selling trends, right? And you just do that over and over and over and over and over. You know, down, 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 up, up, sell, down, 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 up, up, sell. Well, this is sort of like neither of those, right? That's not a trend. It is wedging, and you can make a big deal out of that. Or you could just take a walk. Look how many of these pivots are all clustering. To me, that's sort of a warning sign. Okay, I'm going to move this up a little bit. Okay, you may not need to trade this. Because the SR1, Pete, okay, or the SR1, the WS1 predicts the WR1. So it's an inside week is what I call it. It's neither bullish or bearish. It's neither here nor there. And in fact, and very often, now that you bring it up, very often in this situation, you see the market's moving sideways, right? Like look at these the moving averages. I use the 2155 to discern market, but look at, let's grab the vast majority of the blue line. It's kind of like this. And let's try to grab the vast majority of the orange line, and it's kind of like this. I wouldn't call that an uptrend, right? It's certainly not a downtrend because the 21 is above the 55, but it's really not doing anything. So by definition, I say there is no trend. There is no spoon. There is no trend. So often, at least mentally, I do things like I get rid, of the 21. I get rid of the 55, either actually doing it like this or more mentally. And now I just use an indication of price and support and resistance because there is no market. Okay? Why would you have the 2155? If you're moving sideways, there's no market, so get rid of the measure of market. Okay? So if you want to be around long term, you want to play the game 5 years from now, you probably end up doing nothing here. Think of it, if you're, let's say, a billionaire. How about this? What's the best way to become a billionaire? Never be wrong. And how do you never be wrong? Well, you don't take the shot unless you know you're going to make money, right? At least here, you think you're certain you're going to make money. Well, I look at this, I'm like, I'm not that certain I'm going to make money. Yes, John, Bradian is a good way of, yeah. So, like, I'm not certain I'm going to make money, so moveon.com, right? And that's a powerful lesson, by the way. Okay, so what happened here? We said if you were a bull, you would look for the double bottom, high, low, and all that kind of stuff, and it would happen here. But more in particular, it has to happen there if you're a bull, but it's clearly not bullish. It's more like, I wouldn't call it hope strategy kind of thing, but if you were a bull, it has to do it here. Otherwise, it's just not likely to happen, all right? And it didn't happen, but that's why it wasn't likely to happen. But it's okay. It's not that it didn't happen. It's not like that you're wrong, but you were looking to be a bull at a certain area, which means you were at support and you were looking for reversal patterns and you never really got one. Cool. So what else is in play? What are the bigger forces going on? And look, beauty, ripper. Okay? And look how close we are. Look how close we are. But this is the danger. What if we don't hit the monthly pivot? Okay? How stubborn are you going to be? Okay? Now, I think if you were trading this, you would have had in your analysis that that's potential support, right? This is support. What you really want to do is get down into here. Okay? So how stubborn are you going to be to pick up the what are we talking about here? This is 72.20, 71.80. Yeah, so how aggressive do you need to be to pick up the other 40 pips? Are you willing to give up 40 pips to make 40 pips? Well, if you're in a scenario of risking 40 pips to make 40 pips, what if you just always, for let's say the next 1,000 times that you're in that situation, wouldn't it just come out the same if you just took profit now? Think about it. Let's say 50% of the time you held on and you lost, you gave away 40 pips, but the other 50% of the time you held on and you made the extra 40 pips. Well, then the law averages say, well, over the course of the long term, if you just took your profit now, you wouldn't have to suffer pullbacks and you wouldn't have to be staring at your charts for another 5 hours hoping it drops down to here. And you just walk away with the same amount of money on the long run, right? Because 50% of the time you make the extra 40 pips, 50% of the time you give away the extra 40 pips. So why don't you just take the money now and stop trading? Then you can say, well, I made the same amount of money on the long run because of the law of averages, but I spent 10 hours less per trade staring at this, because we can see this move here. Let's say you get this right and it drops and you make the extra 40 pips. That might take 10 hours. But then there's a good chance it reverses here because it's a double bottom, and and now it needs to do this, and then you take your loss. And if you just took it back here when it was very predictable, yes, you're getting out early, right? You might want to think about it that way, like, oh my God, I'm getting out early. But what if it didn't matter? Like, what if you were sitting here for the next 25 years? I mean, look, I've been doing this for 15 years, right? It's within the scope of possibilities. You're sitting here for 15 or 25 years, 15, 20, 25 years. You've seen this a bajillion times, and you say, well, I get it. It's either going to go up here or drop here. Either way, the difference is 40 pips, so just give me my money now and stop trading. And you're just so much better off just not be in the market anymore. You're done. You're like, well, I drove it all the way to the double bottom. Now, if it drops here and sets up, well, you always got next week, right? You always got next week. Like, you're not desperate for the next trade. You're more concerned about risk and reward, right? You're not trying to impress somebody by saying, look, I risked 40 pips to make another 40 pips, and we made it this time. Woohoo! But what you don't see is that the next time you do it, you lose the 40 pips. So why not just take your money, put it in your pocket, right? Know when to hold them, know when to fold them, know when to walk away, know when to run. In this case, you're not running. It's just like, no, you give me your money. You're like, nah, I get it. It's either going to bounce 40 pips or it's going to extend 40 pips. Either way, if I just take it, it averages out. I put the money in my pocket. I'm not in the market. I have no risk. I'm not doing any work, right? You go golfing. Instead of staring at your charts another 10 hours or 20 hours to maybe make the 40 pips or maybe give back the 40 pips, you're golfing. And 10 years from now, when you add up all those situations where you're in this, you make the same amount of money. But you might have, let's say on 100 trades, work 10 hours less per 100 trades. You're like, dude, that's 1,000 hours where you didn't have to work, but you ended up making the same amount of money. The law of averages, right? Right, unethical is like, yeah, good advice, right? But it's serious. So, like, I think back in 2006, I wrote an article for a magazine about the difference between a really good trader and an awesome trader. And here's the thing. The awesome trader makes less trades, works less hours, and makes more money. And the reason for it is a really good trader knows technical analysis and is probably pretty good on fundamentals and will make 6 or 7 profitable trades in a row, but will work another 3 or 4 hours that day, make a couple of mistakes, throw away a couple of losing trades, right? But here's the thing. Let's say 8 trades in a row and then winners, but then 2 losers. And the 2 losers add up to, let's say, 30% of your profits for the day. right? Those last 1 or 2 trades in there, there's 1 or 2 mistakes for that day, end up costing you about 30% of your profits. But if you were an awesome trader, you're trading when the fish are jumping into the canoe, right? You're just out there, you have nets. Forget about having fishing rods. You have the biggest canoe you can buy, and you have nothing but fishing nets. And you're like, oh, the fish are jumping in the canoe, right? Great. But when it gets a little more difficult, and the setups are a little less good, right? And you're getting a little too close to support and all this kind of stuff, and then you're just like, you know what? It's not easy anymore. I don't want to do it. And you walk away. The other trader might stay another 3 or 4 or 5 hours and take a couple of mediocre trades. Maybe they break even and they just get nothing for those 4 hours. I mean, when was the last time as a currency trader you worked 4 hours and didn't get paid anything, not even minimum wage? But think about it this way. You hang around, the fish are not jumping in the canoe anymore. You hope they are. You're like, oh, well, maybe this and maybe that. You work 4 hours and you lose money. You didn't even earn minimum wage. You lost money. So that, to me, that was the best, most profitable, the most awesomeness of a currency trader. Comes in, goes 3, 4, 5 great trades in a row, takes the money, puts it in their pocket, and they leave. And everyone else stands around and wastes time. Right? And maybe even loses money. And that's the worst. So you measure that over the course of a year, you'll find that the awesome trader might work 30% less hours and make 30% more money than a really good trader that makes a lot of trades but loses quite a bit and works all these hours, is working 40, 50, 60 hours a month, or sorry, 30 or 40, 50, 60 hours a week, and then actually makes significantly less money. And it comes down to quality versus quantity. Knowing when you're like, you know what, I'm just going to take my money and be done. And you're just gone. And what did you do on Friday? Oh, I went golfing. What did the other guy do? Lose 50 pips. What, right? And you know it's true. You've been in situations where, well, you could have gone golfing and lost nothing, but you worked all day and lost 50 pips. Okay? So, right? So I'd rather but whatever. I think you got that. So these little situations, you might want to pay attention to that. On the long run, the law of averages are what's important, right? So we're trying to get you to a point where you're building your track record of success, and that's the difference between having low volatility versus high volatility, right? If your track record shows 7 winning trades and 3 losing trades, it might show like you're up, let's say, 200 pips for the day in winners, but then you give 100 pips back. So you make 200, but then you lose 100, and at the end of the day, you made the 100 pips for the day. And someone might say, well, 100 pips a day, that's really good. But someone else looks at it and says, yeah, but you give a lot back. Like maybe you should just, when you're up, try to figure out, if you're up 200 but you're giving 100 back, instead of making more trades, maybe you need to figure out how to lose less, not make more. You see? Like maybe that's a better way to explain it. Instead of trying to go from, well, I make 200 pips a day, but then I also lose 100 pips a day, so I end the day with 100 pips in my pocket. Instead of trying to get better at entering your trades, maybe you should get better at analyzing the quality of the trades you're entering, right? So that maybe you make 2 less trades per day, and instead of making 200 and then giving 100 back, maybe you make 200 and give only 50 back. Now you're up 50% more money. You see what I mean? 50% more money, and you're actually working less hours. Why? Because instead of giving 100 back, or whatever your actual number is, right? But I'm doing crayon math here. Instead of giving 100 pips back because of mediocre trades, let's say you only give 50 back. Well, you went from 100 pips a day to 150 pips a day, and you're doing less trading. Well, that extra 50 pips is 50% more. You see? And then, so hopefully that filters through the gray matter. And one day you'll say, oh my God, I can work less hours, take less trades, spend more time on the stuff I want to do, like waxing your yellow Lamborghini with a salvage title, right? But actually make more money. And that's where you want to get, right? Isn't that living the dream? You log in, you're like, what do my swing trades do? Oh, made another 300 pips today. Great. And isn't that what swing trading is about? Like, I think swing traders will attest to this. The best part about swing trading is you enter on a Friday or a Monday, and then you come back like Tuesday or Wednesday, and you're like, oh my God, right? Oh, look at that. I'm up 300-400 pips. You're like, that was really cool. I wonder where I should take profit versus all these little trades, right? But let's move on. What time is it? Yeah, we got about 3 minutes, I suppose. So really think about that, okay? Think about that. There is a possibility when you cross over from break-even trading to more profitable trading, right? Very often when I mentor people, I can get them in that situation where they trade less and make more money. And it's such a paradox, right? So another paradox I found in Forex is the less I pay myself every month, the more money I make at the end of the year. And that blew my mind when I was working on the spreadsheets. I'm like, wait, is that true? Right? So the less I pay myself, the more money I will make. So if I pay myself every month, by the end of the year, my account size would have only grown a certain amount, X amount, right? But if I paid myself every 3 months, over the course of the 3 months, the account can grow a little bit bigger. So let's say I want to pay myself $10,000 a month, right? So I take out $10,000 every month, I make $120,000 a year. But since I'm pulling out, it's harder and harder and harder to compound and grow your account size, right? So let's say every 3 months, I pay myself $30,000. I actually make more money at the end of the year, percentage-wise, because the account size has grown, right? It's grown more than if I withdrew monthly. So then I'm like, wait, what if I only pay myself every 6 months and I make more money? You're like, oh my God. Or what if I only pay myself $5,000 per month instead of $10,000? How much money will I make in year 3? And you're like, oh my God, it's triple the amount of money in year 3, right? You're like, oh, I got to get to year 3. So all of a sudden, it's quite a paradox. The less you pay yourself, the more money you're going to make. And significantly more, like quadruple more. Not this month or next month, but in year 3, right? So if you pay yourself $10,000 a month, in year 3, you're making $14,000 a month. Or if you paid yourself little, in year 3, you're making $40,000, not 14, right? So anyways, let's see when I get the numbers. Should come in down here. Let me move over so maybe we can see a little better. Oops, I can't see. Let's do charts only. Big miss. Still hasn't popped up. Yeah, big miss across the board. Crikey. There it is. Yeah. They're not big misses, though. 2.2 versus 2.3. But A miss is a miss, right? Cool. So some people would say the Fed does not have to raise interest rates further. Okay? And remember, what we want is, what I want, how about that? What I want is the Fed to stop raising interest rates. Now, I don't think it's going to happen, but when they all miss, it's a big miss. Really, John? To me, it's all the same. It doesn't compound. But yeah, anyways, nonetheless, a miss is a miss, right? What do you think of this stock market? I love it, Hadir. Okay, here we come. Boom, boom, boom. Yeah, I love the stock market here. Great. It's going to keep going up. Oh, there's no crash, Hadir. There's no crash. Okay. What tends to happen near the end of the quarter and the beginning of the quarter is the people that want to go to cash on certain parts of their portfolio go to cash. So they dump some of their stocks that are, so like, think about it when you're rebalancing, okay? You're rebalancing your portfolio. And you look at it and you have mandates or covenants as part of your portfolio management. This is in your disclosure document. Like, for example, your portfolio cannot hold any more than 5% of the portfolio in one particular stock, okay? And then you find out Apple jumps, 20%. Per share, and now your Apple, the number of Apple shares in your portfolio are now worth 20% more, but that gain might be higher than the rest of your portfolio. So all of a sudden you look at it and your analyst that works for you says, hey boss, 6% of our portfolio is now Apple because the stock price took off. So now you're required to take some profit out of your Apple stock. You're required. That's called rebalancing, because in your portfolio mandates or covenants that's outlined to your client in your disclosure document, right? Your DDocs is you'll never hold 5% of the portfolio in one particular stock, right? So now you got too much of Apple, so you liquidate. It's called rebalancing. So you take just enough of your Apple shares, you sell it, that is cash. Now the percentage of Apple shares in your portfolio now drops back to 5% or lower, but now you got cash, and cash goes up, right? You debit cash and you credit Apple, right? It's just balancing. So now you got some extra cash. This tends to happen around quarters, right? Because that's when you report in your quarterly report. So now we're at the beginning of a quarter. So you cash out of some things. Usually you take your losers, you can get out, and you take your winners and you liquidate. And now you're rebalanced, but you have too much cash. So now over the next 2 or 3 months, you start looking for opportunities to buy. And typically you might have a rule of like, when the stock market drops 3% or more, you want to buy X company, you want to buy Y company, and you want to buy Z company. And you give that to your analyst, and now that's their job. So now they're looking for a down day or a red day in the stock market, and it goes red, 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 and CNBC goes, oh my gosh, right? And really, then the analysts go like, okay, on a day like this, I'm supposed to buy. And that's why you usually have 1 or 2 red days, and all of a sudden, green, 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 and the stock market takes off again. Well, people went to cash. They weren't crashing, they were cashing, okay? And then it comes down, and now they can buy something else. They're like, well, we cashed out of some of our Apple stock, but relatively speaking, maybe Google's down 8%, and you're like, well, we want to get some more Google. So you buy some Google on a down day or a down week, and the stock market recovers and goes right back up. Super simple. Okay? But this idea of, like, some of you guys, like, the language you guys use is foul. This idea, like, well, crashing and stuff, like, it's not the language you need to be using. What do you mean crashing? Explain to me exactly how this, this retracement, right? Explain to me with reason, not emotion, with reason, why you believe this retracement is actually a reversal. Give me economic reasons. Give me central banking reasons. Show me different indicators. Like, well, Wayne, if you look at the transportation subcomponent of the Dow, and you look at this and over the historical average, and then you look at this, and then we have this other concern, and then they're like, dude, you need to be able to, like, write a whole dissertation how you can prove. But when somebody says, like, is there a crash coming? Like, it just says amateur hour. Like, who talks like that? What do you mean a crash? You think professionals sit around talking about the crash? Right? That sounds like you're watching talking heads on TV. And that's dangerous because, right? That's dangerous. My friends come to me and they're like, oh, well, when do I have to get out? I'm like, well, look, I'm watching this indicator. I'm watching that indicator. I'm watching that indicator. Okay, things are elevated, but these things seem to be fine. We're on track. And when you're looking at what the Fed is doing and relative to other countries and stuff, okay, yeah, we're at a mature part of the cycle, but we're fine, right? We're fine. And if you can't prove that to me one way or the other, then it's just noise, right? It's noise. I don't care about opinion. I care about fact. And if you can't prove it, if you can't write a Harvard dissertation on the 8 things that clearly point to the end of the world, it ain't going to happen. Okay? So put it this way. Let me change it. There's hardly any retail money in the stock market right now. It's a big concern. It's all institutional money. So your retirement account managed by a 401k, all this kind of stuff, right? It's not a retail stock market. They got wiped out in the 2008 crash. So this is by and large an institutional market. Okay. Which means the people that are buying the stock market, they make money by charging you assets under management. And if it's an alternative fund, they're also charging you by a percentage of profit. Okay? They make money as long as you're in the stock market. They don't give 2 hoots about you and your mother and your grandmother and your sister and your uncle, and they don't care about you at all. Their number one concern is you do not take your money out of the account. If you take the money out of the account, you're taking money out of their wallet because they charge you just to hold your money. Maybe even, right? And if it's an alternative fund, they're going to charge you 20% on top of that. So what kind of condition do you think the institutional investor wants, what conditions do you think would cause an institutional investor to decide to take a bloodbath in their income? Remember, they might have 10,000 or 100,000 or even 1 million clients. There's no way they care about you. So when does the institutional investor say, you know what, this is too risky for all my clients. I'm making $10 million a year, but I think I'd like to make nothing this year. But it's in the best interest of my clients. When do you think that's ever happened? Now, they talk about it all the time. Oh, we're client-focused, we're client-central, blah, blah, blah. You're client-central. Then how do you get paid? Oh, by the number of assets under management. Then you're like, there's no way you give a crap about your clients. You care. You want to get paid. You want to go to Monaco this winter. Like that's what these guys do. They want to buy a yacht. They want to race. They want to buy a racehorse. They want to buy a yellow Lambo. They don't care about you. So the last thing in the world they want to do is take you out of the stock market. Okay? The guy going, oh, it's the end of the world, he wants to get you in an ultra short fund. He's talking his book. He's just selling you a product. So, like, unless there's missiles in the sky, Like China sends missiles to Japan or something, or North Korea sends missiles to Japan or something like, unless something like that happens, the stock market's going to go up. And it's going to go up more. And you're going to say, oh, it's overpriced. Just go back in history. Was 2003 overpriced? Yes. Was 2004 overpriced? Yes. Was 2005 overpriced? Yes. Was 2006 overpriced? Yes. Was 2007 priced? Yes. So if you got out in 2002 and 2003 because you're like, oh, stock market's too high. Look at these asset prices. Oh, look at that. Look at housing prices. Too expensive. Dude, they're expensive because they're going up and more people are going up. Right? There's no reason economically to get out right now. The rest of the world is just getting on track to being healthy themselves. So you want to get out now, but Europe is just kind of getting together? Look at Europe, hasn't even started their like 8 to 10 year cycle. It's just starting. So what you do, so Hadir's like everything's expensive now. No. Americans are filthy, stinking rich. They can't spend the money fast enough. I go shopping and stuff. It's amazing. You can't get into a restaurant on a Saturday night. You go to a furniture store. There's no salespeople. They're all busy selling crap to people. It's ridiculous how much money Americans have because the stock market's up, the housing market's up, everything is up. They can't keep cars on the lot. It's crazy. So what do Americans do when housing prices are a little too expensive and the stock market is already at all-time highs? What would an American do? Well, think about it. Somebody bought it at the Dow at 8,000 or 9,000 or 10,000 or 11,000 or 12,000 or 13,000 or 14,000 or 15,000 or 16,000 or 17,000 or 18,000, 19,000 or 20,000. I mean, dude, Americans bought thousands and thousands and thousands and thousands and thousands of points ago on the Dow. So lots of people, if they're rich, because then they have institutional money. If you're poor, right? But if you're rich, you bought in at 8 or 9 or 10,000. Your retirement account has doubled and doubled again, and your house is up 50%. Dude, my house is up 50%, right? My friends in California, their houses are up 200%. They're filthy, stinking rich. So what do Americans do in this situation? Well, they don't want to buy more of what they already have. Like, for example, like that hedge fund manager, you know, or that 401k manager, right? All of a sudden they have too much Apple stock. They're like, oh my God, Apple's gone up so much. I have to sell some just to stay within my 5% mandate. So what does that guy would do with his money? Buy some Google stock or buy some more Apple? Well, he probably can't because all of that stuff is up. So what do these institutional investors do when they're too profitable and they have to cash out of their winners and they go to cash? Well, instead of buying the stock market at the all-time high, what do they say? Well, maybe I'll buy the DAX. Maybe I'll buy the German stock market. Maybe I'll, let's look at the CAC. Let's get some money into the Shanghai stock market. Let's and they start looking overseas and they start spreading their money around because they're so rich and because they're already completely overinvested in the United States. This is all free money, by the way, right? Remember, if you bought the stock market at 10,000 and now we're at 22,000, you just like crazy got all this free money that just poured in from your wise investing, right? So now you have all this free money, and now you're like, yeah, get me into China. Yeah, that sounds good. Yeah. Get me into the South Korean, right? Get me into the South Korean stock market. Yeah. Oh, get me in some Dutch companies. Yeah. That's good. And you start investing your money around. What happens to the US dollar? By the way, all that free money from your profits, and you start investing that free money around the world because now you're getting deals. You're getting values. You're buying German stock market at like a 30% historical discount when the United States is at a 30% overpriced, right? So now you're like, relatively speaking, Europe is dirt cheap. So what happens when you do that? Well, you take your US dollars and you exchange them for euros, and with euros you buy, I don't know, Mercedes stock or BMW stock or whatever, right? So what happens? The US dollar weakens because everything in America is wonderful and fantastic, and everyone is filthy stinking rich to the point like they don't even want to buy America anymore. It's too expensive. They're like, well, let's buy some European stock with all this free money I made, right? And that's why when things are great, the US dollar is weak. And by the way, they're not selling the stock market. At certain times, a portfolio manager rebalances and then does something else with their money. Now, maybe the stock market starts to slow down because instead of buying back, right, you cash out of Apple, so then you go and you buy something else. You buy some IBM shares or something. Instead of doing that, you buy Europe. That means the rate of change in the U.S. stock market might slow. The velocity in which you go up will slow. Maybe, right, the angle of the slope flattens. That's okay too. That just shows maturity. You don't want a vertical stock market because then you have a vertical crash. So you just get, like think of it this way. Every month you put $50 into your 401k. That $50 goes into that stock market every month, but all the profit taking gets invested somewhere else, right? So the stock market still goes up because every month people keep putting into the retirement account. It's like clockwork. It just shows up. And then any type of profits get reinvested offshore somewhere. The dollar weakens. Everybody's filthy, stinking rich, right? And all of a sudden then you see China starts to improve. Europe starts to improve, and then all of a sudden China is their factory orders are way up and production numbers are way up, so now they need natural resources. So Australia starts booming, New Zealand starts booming, Canada starts booming. Everybody needs energy, so demand for all that goes up. So oil prices start going up, and we're back to where we are. In 5 years, we'll be right back to where we were. $150 a barrel oil, super weak dollar, and books being written about how the U.S. dollar is worthless and it's not even worth the amount of the paper it's printed on, and the euro is going to take over the world and China is going to take it over the world. The renminbi is going to be the reserve currency, and you can just laugh at how retarded that is because you're wicked smart and you're educated because you and I hang out with each other every single day. Right? Yeah, probably, right? But what I'm saying, John, like that conversation that John's bringing up, that conversation had to do with the TED spread, the yield curve, and the VIX. So, like, never say something to me like, the stock market's going to crash. That's the dumbest thing you could possibly say. Really, like, what does that mean? You feel like, but you could say, hey, Wayne, did you see you see the slope of the on the yield curve? And how about that VIX, right? And you see the spread between the 210? You know what I mean? Stuff like that. That's what you need to talk to me about. Wayne, I'm really concerned about the slope of the yield curve, and they're saying there's a possibility if things could continue that it can invert. Is an inverted yield curve under today's circumstances similar to that an inverted yield curve in 2007? I'll say, well, you know what? That's a really good question. Let's talk about it. Actually, I don't think so, because back in 2007, the Fed wasn't manipulating the curve through, unprecedented, and untraditional central banking actions. So right now, what the Fed is doing is actually, how do you say it? Thinning their balance sheet and trying to normalize. So that's going to do this and that to the yield curve. So even if it inverts now, I don't think that's a sign of recession, because their market conditions and even the business cycle, which is important to all of this, and the economic cycle, which is different from the business cycle, are different. So I wouldn't compare them as apples, but we should watch that yield curve. That kind of stuff is way more intelligent than what about the crash? Well, the crash is coming. The sky's falling, right? That's where I want to get you. So do you guys remember it? I think it was July. The VIX was at like 10, maybe even 9. Do you guys remember that? And we discussed what that meant. What is the VIX? How's the VIX calculated? All this kind of stuff. How is it used? And we went through, and then I discussed the logic of why it was at 9 or 10, right? Remember this? We went all through it. And I said, well, based on what you know now, what should you do? How would you make money with this knowledge? And everybody's like, oh, well, you just buy the VIX. And I think it was the next freaking day, the VIX went from 9 to like 20. You guys remember that? I'm like, well, see, we talked about it. It was logical. But I didn't say, it's the end of the world, it's the end of the world, it's the end of the world, or, all that kind of stuff. It's like, let's talk factual. Remove all of that. So, yeah, so Ray Dalio does talk a lot about that stuff, right, Peter? And he's a cause and effect guy too. And I do a lot of similar stuff than he does. I didn't know it at the time. I didn't know anything about Ray Dalio. But like when my kids were 7 and 8, I would sit on the blanket, we'd have a picnic, and we would talk about cause and effect, like Ray Dalio does. Now, I didn't know that at the time. But there was an egg crisis, I think, in the United States, is the one I'm thinking about. And we sat around the picnic. It was my wife and my 2 little children. We're having a picnic in the backyard. I live on a lake, so you can go in your backyard and have a beautiful picnic. So anyways, we're back there, and I'm like, so there's a scare with eggs, and millions of chickens have to be killed. I said, well, how will that affect people? There'll be less chickens available to people that need chickens, right? So, chicken prices might go up because there's less chicken, but then demand for something else, a substitute, will go up. So maybe people will eat beef, right? And then my wife's like, well, that's not a really good substitute because beef is significantly more costly than chicken. So she said, well, I think pork prices would go up because it's another white meat, and it's also a cheaper meat. So I'm like, yeah, well, that's very astute, honey. Yeah, so maybe pork prices will go up, right? And chicken prices will go up. But what about the eggs? That's the real concern. So we talked about that, and I'm like, well, you used to be able to buy egg futures, but that's long since gone. But I said, well, what about companies like who uses eggs? We broke it down to different fast food restaurants. I mean, they all use eggs for their breakfast products, but some use powdered eggs, and some use liquid eggs. Now, if you're a true analyst and you want to make money in the stock market, you figure out which fast food restaurants use fresh eggs versus which ones use powdered eggs. Because the powdered egg guys have boxes and boxes and boxes of this stuff that can last months and months and months, and they're not going to be affected by a short-term egg crisis because they got boxes on the shelves of their egg powder. But what about the ones that are more natural, like a Chick-fil-A type place where they want fresh eggs and fresh ingredients? So they buy it in giant liquid containers, and they go blah, 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 and they make eggs, right? But the thing is, those are fresh eggs, and we're going to run out of fresh eggs. So do you think like a restaurant's just going to say, hey, we serve 10 million people a day eggs, but we're going to stop serving now? Well, they can't. They're in the business of serving people. So they pay the higher prices, and they're going to be less profitable next quarter because they're paying more. Their input costs have skyrocketed for eggs. So you can figure out who sells a lot of breakfast products, right? And of those, who uses real eggs, because now their prices are going to go up. Their profits are going to go down, and it's going to be announced next quarterly release that they made less money because of the egg crisis. So what you do is you short sell it now. And I'm having this conversation with my 8-year-olds. Cause and effect, right? If a whole bunch of farmers plant corn this year, and it's significantly more corn than every other year, so there's way more beyond the average. It's not the number of acreage of corn, but what is the long-term average of corn acreage? And if we're significantly above the long-term average, that means there's going to be too much corn in the future. And then since they planted corn, they're not planting something else. What didn't they plant? because in the near future there'll be a shortage of that. So short sell corn, buy wheat. It's so simple. And where do you find out, like, where do what do farmers plant? The government tells you. Did you know that? The government will tell you exactly what farmers are planting. They track all this stuff. So they'll tell you. So you can say, well, there's 30% more corn this year than normal, so I'm going to short sell corn because in the future when they harvest, there'll be too much corn. And what was the substitute? Well, the wheat farmers this year decided to plant corn, so there'll be a shortage of wheat. So buy wheat, sell corn. What's the big deal, right? So for example, it snowed in Western Canada this week. You know this, right? Right? You track all this. What does Western Canada, like Manitoba, Saskatchewan, and Alberta, what do they plant? Wheat, barley, canola, flax. So it snowed. It's the beginning of October. They're just starting to bring in the crops, and it snowed. Kevin's like, I didn't know that. Well, you should know this. This is how you make money, right? So there's either going to be a delay in crops, but most likely there's going to be a shortage in grain. Well, why don't you make money with that knowledge? Why don't you do some research? What happens if there's 20 or 30% less wheat this year than normal, or barley, or canola, or flax? Right? They don't plant corn in Saskatchewan, right? So what will it affect? And what about the insurance companies? Oy vey, every farmer in Western Canada, and probably even parts of the United States, right? They're going to suddenly say, you know what? I lost 50% of my crops because of this stupid snowstorm. So I need my insurance money. So someone's got to pay. It's cause and effect. Someone's going to have to pay. Money is going to move. You need to cash in. So futures market. You're like, well, wait, I'm just a currency trader. Oh, okay. Okay, but you see what I mean? This is all cause and effect. Now you have to think this way in currencies as well. Like, why does money cross a border? Why doesn't it cross a border? If you can figure out why money moves, and to me it's more business cycle and investment cycle than it is like what most retail, currency traders think. I think these are big macro moves. And if you can understand that, like, where is Europe in the business cycle? Where is the United States in their business cycle? Where's Canada? Where's Australia? Right? That's what we're really talking about. Where's China in their business cycle, right? So let's say you have your long-term average, okay? And I can't draw curvy lines. So let's say the economy does this, okay, this, okay, and this is like, let's say, 15 years. These are business cycles, right? And then you should be able to look at this, say there's the long-term average. They call that full potential GDP, all right? Or is it L star or P star? P star, potential long-term. Anyways, that's long-term GDP, and this is like GDP falling, crossing below the long-term. Now you're in recession. Then comes back up, recovers, crosses long-term. Excuse me. Now you're in boom times. Then it gets overheated. Then the economy crashes. Now you're in recession. Now you're in recovery. Now you're expanding. Now you're contracting. Now you're recession. Okay? And now over top of this, you should be able to figure out what the central bank is doing, right? Central bank is lowering interest rates. Central bank is raising interest rates. Central bank is lowering interest rates. Central bank is raising interest rates, so on and so forth. And there's an expansion and contraction of the economy, right? But each economy has its own. So where are we right now? Are we at rock bottom right now in the U.S. economy? No, we're actually raising interest rates. So we're probably somewhere up here. And, there are people talking about the end of the world, right? Well, there might be 4 years of upcycle before the end of the world, guys. Where's Europe right now in their economic recovery? They haven't even raised interest rates, so we're below long-term, right? We're below long-term, so well, they're not cutting interest rates further, but they're still at zero. So I'd say like Europe is here on the economic cycle. So why don't you take, so the other way of looking at this is like, let's say you invested heavily when things were cheap, okay? And now all of this is free money. As an American, you're like, oh, this is free money, and your retirement account is overheating. You're like, look at all this money I'm making. Maybe I should cash out and put my money where it's cheap. So you go back here and you recycle your money. You take your dollars, you convert it to euros, and you start buying European companies because they're in a different business cycle, and everything being relative, like Forex traders, European companies are now cheap. So now they get the foreign direct investment. And then all of a sudden, their economy improves and gets back to closer, relatively moving toward long-term, right? Long-term potential GDP. And that, if you can figure this cycle out, dollars weakening, Europe, the euro is strengthening. Now, I'm not talking over the course of minutes, but certainly on a daily chart. Okay? And we saw this, guys, back in here. If you go back to like over a year ago, this is May 2017, European economic data was improving. Do you guys remember that? GDP was going up. Consumer confidence was going up. Even though, right? And the stock market was going up. Now, they were still very early in their cycle, but things were definitely not getting worse. Right? Things were improving, and we were like, oh my God, when is the ECB going to back off their quantitative easing? They don't need it anymore. Remember that conversation a year ago? And then somewhere around here, the good data went away. We had to look at a couple of months, 2 or 3 months of the data actually stopped improving and started getting worse again. But there was a time, so why did the euro strengthen, or why did the dollar weaken? Because Americans were back then at an all-time high in the stock market. Okay, we're at an all-time high in the stock market now, but back then we were at an all-time high in the stock market. So Americans were like, well, maybe I should move some money to Europe, it's cheap. And the euro-dollar went up. Dollar weakened, euro strengthened. And then we found out things were not as good as we thought or hoped in Europe. And we're like, you know what, F you, Europe. If you can't fix your problems, give me my money back. And that's what happened. In fact, the Turks bought as many US dollars as possible, but probably every rich Dutch guy and every rich German and every rich Frenchman, they got out of Europe and they moved their money to treasuries. Okay. Now, treasuries, right? They're taking their bloodbath, but we talked about that. Do you guys remember? We were below 2.0. Then we're above 2, then we're clearly above, and then went 2.5. Dude, you know, along the way, all you had to do was sell the bond market. We went from like 1.7. Where are we now? 3.5? Crazy world. Okay. Oh, I've babbled on too long. I apologize. Once again, I'm living on coffee and adrenaline. Only slept 3 hours, but I'm happy to be here. But I think I should pull the plug and leave some juice for tomorrow. Keep some of the powder dry. But I hope you enjoyed a conversation about cause and effect, about economic cycles, about investing. Because you got to be careful. When you say the stock market crash, it better be meaningful and you better be able to back it up. Because I don't see any reason at the right forced. Why would the stock market crash? Now, some guy on TV might have said it, and some fear mongers and all that kind of stuff. But most likely, in the first couple of weeks of October, it's just rebalancing of portfolios. Okay? Once again, think about the manager, the money manager that's making 10 or 12 or $15 million a year. What do you have to do to that guy to say, you know what, you should cash out of everything. You should freak out. The stock market's going to crash. You should get out. There's almost nothing you can say. Okay? There's almost nothing you can say because that guy's making free money. He doesn't even work. He just sits on $1 billion portfolio over at PIMCO or something and just earns free money. Okay. Well, Greg, normally I would, but because I've been in the hospital all night, I'm kind of like, I don't know if I have it in me. I apologize. I wanted to get going on that, but something came up supremely important. You know, so I went to the emergency room at like 7:30 at night, and I got home at 3:30, and then I was up at 6:30 just to do this webinar. I haven't even eaten breakfast, by the way. This is my breakfast. I haven't even eaten breakfast, guys. So I'm a little bit spent, though. Okay, so I apologize for my portfolio managers. Okay. No, it's not me. A family relative needed to be taken care of. So I had to go in there and just take care of things. You know what I mean? Yeah, so we went a little fundy today. Apologize that. But, you know, these technicals, I always find them, they're just technicals. I mean, you look at takes no thought process. I enjoy the harder, bigger questions that make these technicals happen. I enjoy that thought process a lot more. So when I guess I'm just running on adrenaline, that my heart takes over, my mind is dull, my heart takes over. I'm like, yeah, the stock market crashing. What are you talking about? Prove it to me. And I'll be very interested to hear what you have to say and what evidence you have. Because imagine if as a professional, you talked about such things like the end of the world, but you have no evidence. That's just not cool, right? Yeah. Need a vacation? Yeah, well, I graduate in 2020. So I'm thinking after graduation, maybe I'll take a vacay. Yeah, the future trading techniques and stuff, but same thing like a hurricane. Like, let's do another thing. We're in the middle of a hurricane. If it's hitting Florida, you should have bought frozen concentrated orange juice. Okay? If it's hitting the Gulf of Mexico, taking supply offline for oil, maybe oil prices will elevate. But, you know, again, you wouldn't be doing that now. You would have been doing that a week ago. You know what I mean? Right? So anyways, please subscribe, please like. If you wait 1 minute and then refresh your page, you'll have the archive video. Leave a comment, even if it's just like, hey, thanks, Wayne. It matters to Google or to YouTube. It does matter. I appreciate those comments. If you have a particular question you want me to cover tomorrow, I'll do my best to take that into account as well. But I really appreciate the level that you guys are involved. So again, subscribe, like, and comment. It's really helpful and appreciative. So, and you know, an open account at Trader's Way, right? So peace on earth. May the pips be with you. May our profits be above average. And also, as in regards to the files, programmer gets fired today. New guy gets hired today. So hopefully as soon as like Monday, we're hot to go HOTTOGO. For the other 20% that for some reason can't download. All right, I got to go. I got to get some rest. See you tomorrow, guys. Cheers.